Good afternoon, everybody, and welcome to today's webinar from the Queen's Tech Council. My name is Neil Wagner from the Queen's Chamber of Commerce. We have an excellent program today. We'll be having a discussion about the corporate venture capital landscape. Today, we're joined by three experts in the field. We have Jason Leader from Google, Christian Bodak from National Grid, and Steven Snyder from JetBlue Ventures. Gentlemen, thanks so much for being here.
Thanks for having us, Neil.
All right, so gentlemen, just to kick things off, can you guys tell us a little bit about yourselves, the general goal and philosophy of your fund, and what makes your fund unique? Steven, we'll start with you.
Great, I'm Steven Snyder. I'm the Managing Director for Operations and Partnerships at JetBlue Technology Ventures. I've been with JetBlue Tech Ventures for a little over a year, but prior to that, I was on the corporate strategy team of JetBlue. What makes our fund different from others is that we are really strategic in nature. I think that's something that's pretty common that you're going to see across all corporate ventures, that there be some strategic tie-in. We've got a financial mandate as well, and we want to invest in companies that do a great job of making money and making returns for us and for our sole investor, which is JetBlue. We're a wholly owned subsidiary. But accordingly, because we are wholly owned, that means that JetBlue is really looking for some kind of technology that they could potentially see themselves integrating one day. But one of the real benefits that comes with working with a strategic as well is we can really offer hands-on assistance in building your company. We've got 22,000 crew members, so many of them based here in New York, here in Queens. Specifically, our headquarters are in Long Island City. We're one of the biggest operators out of both JFK and LaGuardia. So 22,000 crew members that you can put technology into the hands of, and also 45 million customers during a good year. Obviously, things are a little different right now, but that allows our portfolio companies to really learn a lot and help to grow with us, and vice versa. I might be missing one or two things in some of the questions that you had asked there, but yeah, last thing I'll throw in, so many of us who work for the fund as well are just so enthusiastic about aviation and travel. I'm one of the only people who's not been behind the controls of an airplane. So many of us are private pilots, where our founder was an E190 and Boeing 727 and 737 pilot as well. So we're really enthusiastic about what we do, and we like to carry that over to the expertise we provide to our portfolio companies.
Awesome. Thank you so much, Steven. Christian, how about you and your work at National Grid? Tell us about yourself and what makes your fund unique.
Sure. So I'm a director on our investment team here at National Grid Partners. We are the CVC and incubation / innovation arm for National Grid, one of the world's largest electric and natural gas utilities. And our goal, very much similar to Steven at JetBlue Ventures, is to find financially attractive companies that also have a strong strategic tie-in to one or more of our business units. Our own operations at National Grid span significant parts of the energy value chain, ranging from on and offshore renewable project development to serving as the electric transmission backbone for the whole of the UK, to also delivering electricity and natural gas through smaller pipes and wires to about 7 million households and several hundred thousand commercial industrial customers here in New York and Massachusetts. So as a result, we kind of focus across four main areas, and that would be startups that either help how we serve our customers, how we operate our networks, how we run more effectively as a large $50 billion market cap company, and how we also lead the energy transition toward a net zero future. We tend to invest in companies, kind of our sweet spot is Series A, Series B, but we kind of cover all stages. We're very flexible in terms of how we participate, and are comfortable leading, forming syndicates, and or following. I think one thing that makes us unique is the way that we help our startups scale in our industry. We've got a dedicated 6-person business development team whose whole mission in life really is to help our portfolio companies navigate National Grid internally. On the flip side, kind of looking externally, we've formed a collaboration network of other like-minded utilities called the Next Grid Alliance. And that serves as a platform for best practice sharing and engaging with startups, including some from our own portfolio. I wear two hats on the team. I do a lot of the sourcing and due diligence around core energy and climate tech related investments. I also manage our fund investments, which we use to get exposure to other geographies outside North America, namely UK and Israel, which are two major innovation hotspots around the globe. And prior to National Grid, I spent about a decade in energy research and consulting, looking at emerging technology at the time, onshore wind and solar, and also doing a lot of work around various environmental policy regulations.
Thank you, Christian. Jason, how about yourself? Can you tell us about your background and a little bit about your work at Google?
Sure. Great to be here. Thanks, Neil. Thanks, Steve and Christian. So my name is Jason Leader. I help lead up Google's VC and startup partnerships team. I'm based in New York City. Actually grew up in Queens, so excited to be here with Queens entrepreneurs. So I'm part of a team where it's our job to help startups figure out how to navigate Google product development, biz development, partnerships. We're a global team. We've got a whole bunch of folks in India, Israel, China, the UK, the Valley. And I'm a little different than Christian and Steven in the sense that I joke around. I don't have any money. I work with all the folks that do have money. So I'll give you, there's a lot of intersecting groups at Google that are, funding startups and also supporting startups. So I'll give you a quick overview of some of that landscape. I think there's teams like myself that support startups and their access to Google. There's Google for Startups. We have an accelerator team. We also have a Cloud for Startups team. Then we have a couple of internal incubation product development teams. So Area 120 is a startup incubation team within Google. Develop companies like Byteboard and others. X is another group within Google focused on developing really new and non-search related entities. So think about Waymo and companies like that. And then there's all the teams that have money. I think it ranges from Christian, I think, has some experience here, in terms of corporate development, very strategic focused, whether it's mergers, acquisitions. They work closely hand in hand with our product teams and strategic initiatives. And then there's at least 5 funds that I know of. There are probably a few that are out there that maybe I'll find about one day, but there's 5 funds in our world that are generally financially driven in terms of returns. There's probably the most well-known, which is Google Ventures or GB. Traditionally in the Series A, Series B range, some seed investments. Capital G, which is usually much later stage. I think companies like Stripe and Airbnb. Then we have Gradient Ventures, which is early stage, focused really on AI ML. They've been very active over the past few years, one of our newer funds. And then we have 2 other funds, which you folks may not know about, is Sidewalk Infrastructure Partners, where Google is an investor, very focused on urban renewal and urban development. Think about really, really interesting stuff like building buildings with timber, which first time I heard about it kind of blew my mind, but it's a real thing. And then Verily Ventures, focused in the healthcare space, doing some amazing things in therapeutics and healthcare. So that's sort of a quick and dirty overview of some of the areas where Google helps with startups.
Awesome. Thank you, Jason. And thank you to everybody that's joining us today. If you have a question for any of our panelists, you can put it in the chat or in the Q&A piece here, and we'll get to it towards the end of the program. So gentlemen, next question for you. This is obviously a space that is always evolving. Can you tell me a little bit about what are some of the general trends that you're seeing right now? Steven, you want to take this one first?
Awesome. Cool. So obviously the last 2 years have been incredibly disruptive in the travel industry with the global pandemic that's going on right now, huge drop in demand throughout most of 2020, but that really came back last year. Now, who knows with everything that's going on around Omicron. So what I think has changed accordingly has been the importance that you put on resilience of startups and on the resilience of the use cases and the technologies that they are bringing forward. We saw so many examples of rapid testing startups, for example, and obviously the need for rapid testing has come and gone over time. But if you have the backbone of diagnostic technology as the technology in the center, and there are a lot of different use cases that you can build off of that, that tells me that this is a more resilient startup that we could apply in a lot of different places. Now, that might be slightly off scope for us, but perhaps for the healthcare fund that Google has, a little more core to them. But bringing it back to travel, there was a big obsession in 2020 and maybe some to this day around contactless and reducing surface touch points. Well, contactless, I think, people have seen over time that's not the main way that that COVID transmits itself. So we've taken from that, though, and we've said, okay, well, there's a big opportunity there towards self-service. So now in the past, I wanted to go to a human being to transact a certain thing that I needed to have taken care of. Well, now with the help of a QR code or with a kiosk, I can actually do this on my own. And that's something that's going to stand the test of time a little better. So from this crisis moment, we've seen an inspiration around the technology to kind of shift things for things that could last beyond just the pandemic.
Awesome. Christian, how about you? Any trends that you're seeing right now?
Yeah, I mean, I guess for us sitting in the energy sector, the biggest trend really over the last year or two has been the resurgence of capital focused on climate tech startups, especially following the clean tech 1.0 bubble burst in the late aughts. And this would also include funds with much greater appetite to invest in hardware related companies. So yeah, I guess, like reading my LinkedIn feed last year, it really felt like there was a new energy or climate tech fund launched just about every week. You had accelerators launching funds, you had new family office backed funds, you had corporates launching energy impact funds, you had the emergence of climate focused financial VCs, and then perhaps most significantly, especially for some of those core hardware innovations, you've had these multi-billion-dollar energy transition funds from name brand PE players announced, in particular over the last 6 months. So I think that's all really great news in energy and climate tech for entrepreneurs, because there's now significantly more capital available at all stages and flavors than was the case just 12 to 18 months ago.
Thank you, Christian. Jason, how about you?
Yeah, I think Christian and Stephen would agree. I think one of the big things we've seen is just and Christian started getting into this, just the sheer amount of money out there and the speed at which stuff is happening. For my talk with our funds, right? The traditional pace of, Monday partner meeting, which seems pretty universal across most funds. And then, you'd have a week to do your to-dos and get back on stuff that all those cycles are now super compressed, hyper competitive, which I think is very, if you're a founder, it's pretty awesome, right? There's a lot of people trying to get into your rounds, get in your cap table. So that's definitely, something we're seeing, and it's not just, it's for people really in the action. I think that's 100% true. I'm curious what Stephen and Christian are seeing there. I think one of the big trends I see in terms of, investment areas is, on the creator front, probably a bit more in our world, just, as, TikTok and other platforms become, more pervasive, right? Along with YouTube, obviously, of course, how are we going to incentivize creators? How are we going to, have them, develop, whether it's their video, their text, or all those types of things, right? I think Substack as well, right? How are you going to get them funded and, develop true incomes?
Yeah, I think exactly to your point there, Jason, it really brings about how we have to differentiate ourselves as firms, and where corporates do a good job of differentiating themselves and all the resources that you can open up from, I think we're all extensions of Fortune 500s or, other similarly very large companies here, and all the amazing resources that we have. I think institutional has had a very good run, of course, and this is not to throw shade at institutional VC, but money is money, a check is a check. And obviously so many of them are very differentiated in terms of the networks that they can make available for you, but you really have to be clear with the founders that you're working with what the differentiation is that we provide, because you're right, Jason, they definitely have a lot more power now, the founders.
All right, thank you, gentlemen. Over the last year or two, you've talked about things have changed a lot. Has there been any changes in the amounts invested, investment terms, investment timelines, or anything like that, or is it pretty much the same as it was pre-COVID?
I mean, just as we've seen inflation in the real economy, there's also been a significant amount of inflation in startup valuations. I think in the latter case, it's probably primarily been driven by demand and the surge in capital, at least that we've all spoken to in the last question. As an investor, I think it's meant having to walk away from some deals. As a startup, it's a bit of a double-edged sword. On the one hand, it's allowed startup CEOs to raise new rounds with less dilution, and so that's great. On the other hand, I think there is a risk sometimes that those rounds are being raised at valuations they haven't yet grown into, which creates some added pressure going forward after the round is closed.
Yeah, I agree. You're seeing unicorns at earlier and earlier stages that you never would have thought of before, or Series A unicorns, or valuations that they're raising for that would add up to over $1 billion at Series A. And when particularly for us as corporates, it tends to be smaller check sizes that we are writing compared to institutionals. Not in every case, and every now and then we will lead around, but it means accordingly for us that you're occupying a really tiny space on their cap table for everything that you're offering in exchange for similar check size that you could be providing to an earlier stage or a more modestly valued company. I think the one change beyond that I've seen, it ties in with different kinds of industries that we're looking at now. I think our focus on sustainability has gotten a lot stronger over the last few years. We had invested in an electric aircraft company very early on, an electric vertical takeoff and landing company. Now we are starting to see more heavy industrial opportunities there around alternative fuels, around electric aircraft, around hydrogen-powered aircraft. We invested in a company called Universal Hydrogen that is going to be completely rethinking the power frame on the aircraft and doing that with hydrogen as an alternative fuel. Accordingly, things like this are more expensive from a capital perspective than SaaSes are. So I think if anything, that nudges things into a higher check size than we have historically done. But I think it's good. It teaches us a diversity of different kinds of companies that we want to get involved in, and we learn a lot in that process.
Thank you, Stephen. Jason, anything you want to add to that?
Yeah, I mean, I would definitely say, right, I mean, the numbers are, if you look back 5-10 years, the numbers are just, magnitude larger. I mean, if, now, Series A at, multi tens of millions of dollars is not, that's kind of a regular day, right? Versus, that happened 5 or 10 years ago, that would blow your mind, right? So yeah, no, there's a tremendous amount of more money out there. I think, Christian started to, get into this in terms of, if you're a founder, you need to make sure that, you can live up to those standards. And I think there's other after effects, some, founders, CEOs, their teams need to think about in terms of hiring and, managing expectations at each round. And also, if you're a startup and you're already a unicorn, and you have to, if you're looking at prospective employees, right, how are they, what's the path for them in terms of, increasing that valuation, right? And as they think about, putting some chips on the table with you, so.
Yeah, the other thing that occurs to me, and maybe putting on my funds hat for a moment, is that with this kind of general acceleration across the industry, you're having funds coming back up to raise again with their LPs more frequently than you might have expected in the past. Maybe historically the norm was every 4 to 5 years, typical investment period. Now it's in some cases as often as every 18 months. And so they're just putting a lot more companies through their portfolios. And it's just something I think a question you might want to ask, funds as you're talking to them, where they are in their fundraising cycle, how often are they re-upping for new funds, and how does that affect their ability to really serve you as a portfolio company?
Thank you, Christian. So the three of you obviously work for, three very different funds. Can you tell us a little bit about how you guys work with other funds? Do you guys compete? Do you guys, go in on investment together, or how does that relationship work? Christian, you want to start?
Yeah, sure. I would say, there's competition, especially for some of the very best deals. Companies consistently doubling revenues with high margins and applicability to multiple verticals. However, in an area like energy or industry 4.0 more broadly, it's such a large market that there's going to be multiple winners and room for lots of funds to support them along the way. And so, in our experience, I think it's probably more collaborative than competitive. Personally, for example, I've got a number of other funds, either financial or corporates in other industries, where we have regular deal flow calls we've set up, bi-monthly basis. We like to co-invest with one another. In many cases, you'll find companies who've raised their seed, their Series A from financial investors, but then are at a point in their life cycle where they feel like it's the appropriate time to bring in a corporate a CVC group, and so it's a lot of times we come in alongside other CVC groups representing different industries, and that tends to work really well.
Great. Jason, or sorry, go ahead, Stephen.
Oh, sure. I think you have the access to the due diligence resources of the other firms that you don't have, what you don't know, but they might know. And all these reciprocity opportunities here for Christian, for example, National Grid and our National Grid partners, I should say, and our firm have both invested in a startup called Tomorrow.io that provides amazing, hyper accurate, hyper real-time weather forecasting from the ground level. And although I don't believe that we had exchanged notes on that one, as this was several years back now, we each add different strategic value to it, and we're each served strategically in different ways by it. So I think there's a huge complementarity to when we're exchanging deal flow with each other. And, it could be that insight that the firm needs that we are not able to provide that ultimately serves the firm well and the portfolio company, and then helps us with our fund overall.
Yeah, I think collaboration is key. Sometimes depending on the stage of the fund, the funding round, the collaboration may be a little bit tougher, right? If it's a hyper competitive deal, think Stripe or Airbnb, super late stage. But collaboration is really important, especially the earlier stages, right? Because if you're a especially with these compressed cycles that Christian talked about, on the funding side and with companies, part of an investor's job is to help that company get to the next level of funding. So there has to be collaboration between the funds. And also just with these rounds being so large, right, it's pretty tough for anyone to cover a full round these days. So there definitely has to be collaboration there.
Awesome. Thank you, gentlemen. So one question that a lot of people ask when they're just starting to learn about venture capital is how you guys discover and assess different investment opportunities. Can you speak a little bit about how that process works? Jason, can we start with you?
Sure. How do you think about different types of opportunities?
Yeah. How do you find different investment opportunities, and how do you assess them when they come in?
Yeah. So yeah, I think the investors that I work with, right, it's largely there's a large part of their job is their network, their established network. Previous founders, previous senior level executives at startups, generally, understand the game, know how to start companies, go from 0 to 1 and beyond. So that's always a great pool of folks. I see GB doing a lot of that in particular. So there's definitely pools there. And then there's obviously, I think Stephen and Christian would agree, right? Being part of a big corporate provides some deal flow there as well. There's things that I see that I will often share with our investors. Mild success, but some. And then, yeah, how do you assess deals? I think, I'm definitely interested in what Christian and Stephen would say here, but obviously it's, with the sheer number of startups out there, right, and the success rate, being what it is, right, startups need to have a big, monstrous, hairy problem with a huge total addressable market, right, that that can be tackled, right. I think beyond that, right, it's obviously there's definitely focus on the team, the founder, their ability to attract additional funders, employees, and really build something special. And then I think, is there some unique insight based on those experience and skills that will help them crush that, total addressable market? So.
Thank you,
I guess
Jason. Or Christian, go ahead.
I'd echo some of those kind of same deal sources. A lot of inbound via my and other investment team members' networks. In some cases, we get contacted directly by startups as well. That's probably a majority of the deal flow. There's also a fair bit of outbound. One thing that we do for our various business units is occasionally we'll do a deep dive on a particular sector. They'll come to us with a challenge, and we'll say, here, it sounds like most of the incumbent vendors who we're more accustomed to dealing with haven't developed something yet in this category. So we'll go out and do a bit of a market scan for you, and then curate, bring forward just the top 2 to 3 companies that we think could be worth looking at commercially. And that has been actually a pretty successful model for us to find companies that are both investable as well as good partners for our operating businesses. Occasionally, we'll learn about companies, sort of diamonds in the rough, that somehow National Grid is working with, but it's such a big organization that we've had no exposure to the company before, operating a little bit under the radar, but end up being really interesting investment prospects. And then lastly, I'll mention, so funds, which is one of the areas I look after. It's actually been a pretty fruitful part of our deal sourcing strategy, in that primarily we're invested in funds that are focused earlier than we are, and in other geographies where we don't have boots on the ground. And so we've often led follow-on rounds for some of their portfolio companies. So we get a bit of an insider view on the companies, since they're already part of the portfolio, and we've got that indirect investment in them. And again, to Stephen's point earlier, can kind of share in some of the due diligence that's already been done by our fund partners.
Yeah, Jason and Christian summed it up really well. Similar to Christian, we do a process called innovation sprints. We define an area of need within the organization where the old ways of doing things just haven't worked that well, or where the technology providers that are in there have gotten a bit less innovative, and where we need to inject some new ideas. We did one last year on ESG, one on payments technology, because stuff has changed so much so quickly in that area. We're currently doing one on customer self-service, and normally we'll put out a little call. And I had seen a question about, how does a first-time founder get in front of you? Well, we've got an inbox. We solicit all kinds of ideas, and we do try to get back to everybody who does pitch us. When it comes to the assessment, we part of my role leading operations is to help interface with our parent company of JetBlue, as well as the other international partners that we have, Air New Zealand, CAE, which is the largest equipment manufacturer of airline training equipment in the world, based in Canada, and JSX, which is a regional airline based in Texas, but actually with operations all throughout the country. And we can tap into all of the expertise that each of these businesses have. So if you have a startup working on predictive engine maintenance, for example, we've got 5 experts on predictive engine maintenance at JetBlue. That's normally one of the calls that I'll do when we are doing due diligence, put it in front of these companies, put them in front of these leaders, and see what they think, and have that help guide our opinion forming here. It works the other way around too, that we're constantly talking to these leaders and understanding what their needs are when we do outbounds, when we are trying to source in specific areas. And yeah, a lot of tapping into all that expertise really will factor into an investment decision for us.
Thank you, Stephen. All right. So when you guys finally do meet with a founder, what are some things that they or their company can do to really stand out to you guys? Christian, you want to start out with that?
Yeah, I mean, so like most funds, we look at how big is the market, how strong is the pain that they're trying to solve for, how unique is the solution, does this kind of sales partnership strategy make sense, and is this the team to actually commercialize the idea? Ideally, we look for repeat founders. We like to find companies that can sell into multiple verticals. Utilities, energy, it's a big TAM, but it's a damn hard vertical to sell into. So ideally, we want companies who are applicable to our industry, but also have other irons in the fire. And then, we typically look for some demonstration of strong product market fit, usually as evidenced by, scaling early revenues. So I think, that's what we look for, I guess, just right up top. But.
Awesome. Stephen, Jason, what are you guys looking for in founders?
So I think really exceptional founders do a great job of understanding what the need is, what the problem is. I loved the way that Jason put it, big, hairy, monstrous problem. I might steal that one in the future. There's a lot of really great technology out there, but it's unclear who needs it and why they would be willing to pay money for it. I think to Christian's point around traction and demonstrating revenue, oftentimes we're starting to talk to companies when they're at the seed stage or even earlier than that, but actually only investing once it gets to around a Series A, plus or minus a little bit around there. So you do have to be willing to take leaps of faith when it comes to seeing that the revenue will produce itself, particularly if it's more industrial and less consumer facing. With all that said, we do want to understand that they have thought about things properly and can justify that there is a need for it, and that this is something that either travelers want or parts of the supply chain within travel technology actually want, instead of just sounding like a really cool, bright, shiny object.
Yeah, I definitely echoing what Stephen said. I think it's important to think about it as a sales, any sales negotiation process, in the sense that you want to build confidence in you, your team, what you're trying to do. And depending on the stage, right? Of course, you may have more evidence than certain later stages, but whatever evidence you can bring to the table to show that you understand the market in ways that nobody else does, and you have some edge, that will be, that's really truly significant. I think. Obviously it's sometimes helpful if you can, find someone to help you make connections to those teams, to the investing teams. But again, it's really building, confidence in your ability to solve the problem, no matter what stage you're at. So.
Perfect.
Yeah, the other thing I'll add, just kind of more with the strategic lens, is you've got to have that kind of compelling strategic fit. But I think how you define strategic fit depends upon what CVC you're pitching to. I think about things typically in terms of like 3 archetypes. There may be more, but one archetype of CVC is like they're out there investing primarily to inform their corporate strategy. So looking for companies that help them see around the corner to get early insights into where their industry is headed. A second archetype, and Intel Capital probably embody this best, is looking for companies that can help me grow my ecosystem. Probably some of Google's investment arms represent this well too. But helping startups that drive new sources of demand for the parent company's product or service. And then the third, which is where we tend to play a little bit more of the time, is augmenting our supply chain. So does the startup have a product or service that addresses a pain point not solved by incumbent, and that is also really ready to deploy today?
Great. So those are some things that, or sorry, go ahead, Jason.
I was just going to add, I think, we talked before about it is a really opportune time for founders. But I do think on the flip side, there is more is expected from founders in terms of the traction they can make at earlier stages, just because of all the tools that are available. So it's the more I think, especially when these the Series A or even seed rounds are pretty high dollars, right? There's the expectations are higher for the founder and their team to have made some progress, if not sometimes even significant progress.
Awesome. So those are all things that you guys like to see in founders. Is there anything that you see people do that are like immediate red flags or absolute don'ts for people out there?
Get a warm intro. I mean, it's really hard to kind of make it to the first stage from just the cold outreach.
I think in that vein, make it as simple as you can in your email or your website or just whatever it is. The thing I like to talk about when I talk to founders about pitching is, give someone a gift they can hand off to someone else, right? Whoever it is, Christian or Steven or myself, right? We're gonna have to convince ourselves, but also convince our partners or our teams that this is a thing they want to do. So you have to make that really, really easy to do. And that starts with your email. And sometimes I get emails where it's just like, here's my deck. And then you're putting the work on the other person. You need to do the work and make it super, super easy. So.
I love that, Jason. My analogy for it, I've thought about doing a corny think piece on this, and maybe you will see it on LinkedIn one day. What I learned about being a VC from being trained as a baggage handler, because I did go through that training, and that you put the wheels out and you put the labels out. So the next person who's getting it can easily just flip it over and send it to the next person and know if it belongs on this flight or on a different flight, et cetera. So to that point, I really appreciate founders who have done their research on us and understand why JetBlue Tech Ventures would be a great fit for them. Because not every strategic is right. I can't offer the same sorts of benefits that a different strategic can. And that's a good thing and a bad thing, because it means that I've got really specialized interests. It also means that I'm not for everyone. And that's fine as well. If I'm just really getting the boilerplate spam one, you're spreading out, you're taking a lot more low percentage shots, and maybe some of them are going to hit, but chances are they're not going to hit with someone who is discerning why you've thought through why it's a good fit. And
Excellent.
maybe one more thing I'll throw in on that, and backing up Jason's point too on the elevator pitch. If you can't say succinctly in 1 or 2 sentences, if you've lost in the first 8 seconds the attention span of who it is that you're talking to, not only are you not going to be able to sell me on investing, you're not going to be able to sell your customers. You're not going to be able to sell your prospective collaborators in this venture. You're not going to be able to attract top talent. We want to see that you have a very succinct way of explaining yourself, because if not, then we think that you're not going to do a good job of carrying forward the business.
Excellent advice. Thank you, guys. So when a company is pitching you, what can they expect from the process? And I know it's a very long process and there's a lot to it. So just from like a super high level, what can people expect from you working with you guys? Christian, want to take this one first?
Yeah. So, we'll do an initial call, half hour, 45 minutes, something like that. If it sounds interesting, potentially strategic, nice financial profile to it, then usually the next step is we'll set up just an intro call with our BU to kind of gauge their interest. And then, in parallel, also do a bit of a preliminary read of the financial outlook, looking at your data room. If everything checks out, then we bring you forward to the first of a 2-stage investment process, which we call deal concept meeting. And there, it's kind of split between two hours. The first hour, you pitch and answer questions from our investment committee. Then the second hour, you leave the room, and whoever the deal lead is will discuss the merits of the potential investment and also the potential strength of the strategic fit. If approved at that stage, essentially that's like a hunting license for those of us on the deal team to do further due diligence in terms of detailed financial modeling, management and customer reference checks, and then further validating the strategic fit with the BU. And finally, if that all continues to look good and check out, then we bring a deal back, usually anywhere between 2 weeks to 2 months, back to the investment committee for that final approval to either issue a term sheet or write a check if we're co-investing alongside somebody else.
The first stages of ours sound incredibly similar. I think maybe where our paths diverge is around getting that green light from the rest of the team. Usually, if it does have the business unit support and if things are starting to check out from an analysis of the data room, we'll start writing the memo. We'll bring it to our investment committee composed of JetBlue executives, an outside executive, an executive from the ancillary business that JetBlue owns as well. And with their support and with the rest of the round falling together, usually that will point toward a decision. A similar timeline to Christian's. I think the fastest successful one that we've not had any heartburn about was 2 weeks. The longest one, if everything else was happy path, would probably be 2 to 3 months. Obviously, the happy path implies that everything else in terms of closing the round is going well. Sometimes there are ones that are no-brainers for us, but we work together with the startup to help them close the round and help them find a lead. So we tend not to, but not exclusively don't lead rounds. So if for exogenous events it has to take longer than that, then that happens quite often. However, I think 2 to 3 months is a good target.
Yeah, our process, we have a whole bunch of different funds. The processes will be fairly similar to what Stephen and Christian outlined, depending on the fund. I think, as initial first steps, we generally do a quick screen, right? For fit, depending on the fund, right? That will be, what size check the startup is looking for, what round they're at, what industries they're in. We'll allow our teams to do a quick, does it make sense to have a quick, does it make sense to have an intro meeting? And then once the intro meeting happens and, if there's interest, then we move on to, the other parts of the process in terms of diligence, talking with customers and digging a bit deeper. But it will depend on the fund. But I think overall, we try to be upfront as possible in terms of, just even the first step. So.
Awesome. And the last question I have before we move into the Q&A is, in your experience overall, what makes for a successful investment partnership between you and the company? Stephen, you want to take this one first?
Sure. As a pretty strategic fund, I think if each side is adding value beyond just the money that's going through, I think we want to add value from the expertise that we have, from all of the customers that we serve, from the commercial channels that we can help open up. We're careful about setting expectations just because JetBlue is sourcing and our other partners sourcing. It's completely independent of us. But if we can help them open doors, if we can help them learn something from our corporates, and if vice versa, if they can help our corporates learn something, then I think it's a really mutually beneficial process. Yes, of course, it's helpful if there's a good financial return on it as well, but we're really hoping that it provides good symbiosis from a strategic perspective, because if it does that, then it will convert into longer term financial success for everyone.
Yeah, just kind of following up on what Stephen said, I think it's very similar for us. We actually have a fairly recent example of a portfolio company where we helped introduce them to the business. They ended up doing a commercial deal. It's still at the point of kind of scaling out to other similar business units across the company, but it's saving us significantly in our operating costs, which ultimately gets passed directly down to customers. So hopefully will result in lower electricity and natural gas bills at some point in the not too distant future. But then similarly, besides serving as a customer for them, we have a separate innovation function who help them incubate an entirely new business line, leveraging the kind of the satellite data and analysis that they do. And as a result, they've set up this subsequent business line in the climate tech space, and is scaling it and moving beyond just us as an initial customer. So it's a lot of that kind of give and take in terms of both parties bringing value into the partnership.
Yeah, most of my work is on the post-investment side of the house, and I think the way we talked about how you get investment, a lot of that I can see it all flowing over into the post-investment side in terms of, the founders and their teams when they've got their stuff together, they're engaged, they have ideas, they have, things they want to sort of, share and develop in conjunction with us. So yeah, I think, obviously, yes, there's Stephen said it right. There's the financial aspects, which is, why you invest. But yeah, I think in general, when you have a good partnership, there becomes engagement, collaboration, a rhythm to your relationship, a general openness to working together, which is hypercritical. Yeah.
Perfect. Thank you, guys. All right, moving on to the Q&A. We have a lot of good questions here in the chat. First question is, this is for anybody if you guys want to jump in on this, but this is from Tim. How do you balance strategic interests with a diversified portfolio? Will you place bets on competing companies?
Yeah, for us at National Grid Partners, we will not invest in companies that are direct competitors or likely to overlap significantly in the future. So that's, I guess, one way that we try to avoid internal conflicts with our portfolio. And I think that also, by not investing in direct competitors, ends up forcing us to diversify into other segments of the value chain and to have a broader portfolio.
Stephen, Jason, anything you guys would like to add to that?
No, we're similar. We tend not to. I can't recall an instance where we have in the past, and I don't think that we would ever plan to, because we care about the growth of the companies that we invest in, and we don't want to do anything that is counterproductive for them. I think that maybe if they're case by case, but as a broad rule, we tend to not do that. Strategic interests versus the diversified portfolio. I mean, there is no investment success without strategic success, and no strategic success without investment success. So we try to balance things across 5 investment themes that we have, which we put on the website, which are a good signal for entrepreneurs who are approaching us as well, in terms of where do you fit in within our buckets. We do try to evenly space those out. And I think by doing so, that's how we achieve a balanced portfolio.
Yeah, I would, it depends on which investment arm, but GV, for example, Google Ventures is strategic. They're strategic investors, but yeah, they're not going to invest in direct competitors to Google. Yeah.
All right, moving on. Kevin Duffy asks, how do each of you think about your fund's hands-on approach with investments? Specifically, are you active with management team, or are you guys passive investors typically?
We're typically pretty active. We like to take board seats or observer seats, so active from like an investor standpoint. Plus, as I said before, we've got this BD team as well as their Next Grid Alliance coalition, where we try to be pretty active, at least in terms of customer intros, that type of thing.
Yeah, we're also quite active. Try to engage and help as much as we can.
We're of a similar nature. I think the only exception to where we are not is once we've gotten a startup to a place where they are really off and running on their own and they don't need our help anymore because they've hired up and they've reached really late stages. And we consider that a success when we don't have to, when they've built that skill within themselves.
Awesome. All right, next question comes from Mike S. You guys mentioned you normally look for founders with track records or connections, but what is the best way for first-time founders to reach you or similar VCs?
I think we read everything that comes into our open inbox. I don't have the email address memorized off the top of my head, but I'm going to go check it and I'm going to drop it into the chat so folks can send stuff there, or if folks reach out on social networks. But I will echo what Jason was saying earlier. Make sure that you're putting your best foot forward in those cold outreaches, because I do, maybe this is a life frustration, but a lot of us get LinkedIn requests where I see you're tiptoeing around what it is that you want to do there. You're saying, oh, I'd like to add you to my professional network, and I don't know what to do with it. I don't know where to send it next. I don't know if you're looking to raise a fund or raise a round, I should say, or try to get something in front of one of my business units. So to the extent that you can be direct about what it is that you're looking for, and that you've done your research and that you're encapsulating what it is that you're trying to accomplish very well, I find that to be really helpful.
I think you need to be creative. I'm sure there's, companies that Stephen and Christian have funded that maybe reaching out to one of those founders or one of the senior folks on those teams, especially if you're in the same industry and you're working on a problem that might be interesting to them. So I think, that's just one example, but I think there's ways to, open doors, especially with the benefits these days of Twitter, LinkedIn, YouTube, et cetera, right? There's a lot of ways to get a lot of intelligence. You need to do the homework.
Absolutely. I mean, I think our expectation going in is that, founders are supposed to be scrappy and creative, to your point, Jason. So, and especially if you're commercializing a new technology or service in our industry, the degrees of separation should be somewhat, small, such that you could leverage your network to connect with us somehow.
I also, echoing Christian, I think, listen, it's one thing if I email Christian or Steven, right? But if a founder who's in the industry and has sold, millions of dollars worth of product in that industry says, hey, you should meet with Jane, right? That will have a ton more value than, someone who has nothing to do with the industry. So trying to connect those dots, I think Christian or Steven would take that call pretty quickly. So, but I won't speak for that.
All right. So moving on to the last question, it is how do you balance finding innovation opportunities for your parent companies versus making strategic returns?
So we put equal emphasis on the two. I think maybe echoing even one of Steven's comments earlier, like you can't have strategic returns without financial returns. Company needs to be successful independent of your relationship with them as even a very large customer. So the two really go pretty hand in hand. And you can't have, I suppose you can have financial returns without a strategic relationship. And in some cases we do. And, I guess that also helps, carry some other investments in the portfolio. So we get that, end up with that 50-50 balance at the end of the day. But it is really a combination of the two.
Yeah, we balance it through, we just have different teams working on different, in different areas, right? So corporate development for us is very strategic, while Capital G, for example, is, financially driven. So that kind of keeps the lanes a bit separate.
And if I had anything else to add, maybe it's just that you don't necessarily have to think of these two as mutually exclusive. I had talked about the innovation sprint process that we do at JetBlue and JetBlue Tech Ventures. We could very well arrive at the end of an innovation sprint process and find a company that is really exciting for one of our business units to partner with, do a POC, et cetera, but just doesn't meet our investment criteria. It might be a little too early stage, a little too late stage, et cetera. But we just came up with a really great strategic win for the organization that brandishes our internal credibility within JetBlue and will then feed more deal flow from JetBlue folks, will feed more opportunities that we can offer startups. Ideally, we would hope to get some kind of equity or some kind of warrants out of, crafting a deal like this, but maybe it's just for other reasons, not something that we would invest in. And overall, I think that's still a success for us, even if it doesn't go into, our IRR or anything like that.
All right. Well, thank you very much to everybody for sending in your questions. It looks like that was the last one. To our panelists, any last words you have for our audience here about corporate venture capital?
I think one of the big things that I heard today was, try to do your homework as much as you can. Yes, you should, be aggressive and, cast a wide net, but it's, fortunately, these days, right, a lot of the information is out there. You just got to find it, and it's not that hard to find, right? You can figure out, what the last company any of us is invested in, what types of companies we're looking for, and utilize that information as best you can. There's a ton out there. So that's one thing I would definitely think about.
I would just echo that I'm grateful for everyone for taking so much time on a Friday afternoon when you could be clocking out on a long weekend, no less, as well, hopefully coming up for everyone. I hope if there are entrepreneurs out there who have really fantastic ideas of how we could collaborate together, I would hope to be in touch. I hope that if the audience as well, I believe includes some folks who are at the beginning of their career and who are looking for career paths, I'd really hope that you consider corporate venture as part of your destinations.
All right. Well, thank you so much to our panelists, Stephen, Christian, and Jason. You guys are all rock stars. And yes, thank you very much for joining us late here on a Friday afternoon. And special thanks to all of our attendees for being here too. Again, my name is Neil Wagner from the Queen's Chamber of Commerce. Thank you so much for being here for this presentation from the Queen's Tech Council. Be on the lookout for more of these at queenstechcouncil.com and queenschamber.org. Thanks a lot and have a great long weekend. Take care, everybody.